All right, so I'm Jason Yarusi of Yarusi Holdings. Today we are going to talk about underwriting and refinance and exit strategy. Please, if you want to hear more about us and our company, you can go over to yarusiholdings.com and go down there in the comments below. You can find our YouTube channel. Go down there, link, like, subscribe for more great videos like this. So when we are underwriting out for a refinance or an exit strategy, we ultimately want to look at how that would impact the investment. What would be the benefits to both, right? So if we want to look to underwrite, to say we are going to refinance in a year 3 versus sale at a year 3, what would be the benefits, not only to the investments, but for the returns for our investors? Now, we look at both parts here, because typically we offer a syndication, and although we would love to hold properties for the longevity, the syndication is offering of a security that ultimately has a time lapse. Typically we partition in anywhere between a 5 to a 7 year hold, ideally. However, during that hold period, there will be potential opportunities where we have improved the property, where we can go and look for a refinance. And the ultimate goal of that refinance is that we're going to capitalize on all the improvements we've made. And the refinance typically is going to be looking to increase our loan basis with a better loan structure and ultimately taking out capital, right? Taking out some of the equity that has been invested by our investors. And we can return that equity to those investors. So typically they can go and invest into another one of our offerings. They can go invest into another vehicle that they look to invest, or just use that money for other things within their life here. So typically we look for that refinance and how potentially it can benefit the property. Now, why would we not refinance always? Well, if we're looking to sell very shortly after here, it may not benefit the property. We may incur a lot of costs to do this here, and we're basically going to incur these costs just to capitalize on the sale event shortly after. Ultimately, we may not have hit the level of improvement needed yet to refinance. So ultimately, the bottom line, the NOI, will not sustain the increase in loan amount for the increased payments to benefit the investments here. So we want to say, well, how can the refinance be used accordingly? Well, when we hit certain pinnacle points here and the market is accordingly trending, where we have good loan options here, we may look to use that loan to carry forward the benefits of the property. And that can return capital to the investors and push forward the metrics. For our assets, we're typically looking at 4 different returns. We're looking at the cash on cash return, which is basically the return that investors get year on year without the sale. The average annual return, an average of all the returns, the cash flow each year the investor gets, plus including the profit, that will be averaged in. The internal rate of return, which is basically the return of money, the velocity of the return of money to those investors. And this is where the refinance can really have a big impact. And ultimately, the equity multiple, meaning that if the investor invests $100,000, once that money is returned, how much more money do they return or do they have distributed to them between the cash flow and the profit from the sale throughout the hold, or throughout the life of the hold? So we want to say, what can be the best event here for the investor at that time? Now, we have chosen to exit early on 8 of our properties in the last few years here. We've done this because 1, we've been ahead of our business plan, and 2, the market has seen tremendous growth here. And it's always better to have, a bird in the hand than 2 in the bush. So we say this will be a better moment for the investor than waiting for the uncertainty that can carry out into the future. So ultimately, the goal here is, what is my favorite exit strategy? It's the one that's going to benefit investors most. What is going to be most beneficial to the investor at this time? So if we look at our business plan and we look at how we have now performed throughout the life of the hold here, what is going to make best sense? Sometimes it is to refinance, to put a better loan product than potentially was available when we took over the property, or could capitalize on the current state of the property. And other times it is going to be looking to sell the property here. So quick steps for underwriting and refinance here, looking at where you are at, how much improvement has been capitalized in here, and what would be a new loan amount, and can you sustain that where the NOI is planned to be. Now, you do have to keep your head on the swivel. I'd like not to partition on that the only path forward will be if we refinance at a certain point of the hold. If the deal does not work, because if a refinance cannot happen, that exposes us to a lot of risk in these investments. So we're ultimately looking to say, what would be the best path forward for this investment at this time? And we want, from the start, when we do underwrite our assets, to look at the investment itself and know it can sustain whether we have a refinance or not. That puts ourselves in the best, safest position, not only for our property, our assets, but also for our investors here. So as you go forward and you look at your business plan, say, what is going to benefit this property the most? What is going to warrant the best returns for the investors at this time in the cycle? All right, so if you like what you heard, go down there, find links to more great episodes over at yarusiholdings.com and also on our YouTube channel. Hit that like and subscribe button. Thank you so much. Let's do this.